Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome to The Explainer. Today, we are tackling one of the absolute best tools you have for building your financial future, the individual retirement account. You know it as the IRA. We're going to cut through all the jargon and give you a super clear, actionable guide for 2025.
Look, if you've ever felt like the whole world of retirement savings is just a lot, maybe a little confusing, trust me, you are not alone. But stick with me because we are about to turn all of that confusion into real confidence.
Okay, so first things first, what is an IRA? This is really important. An IRA isn't actually an investment. It's more like a special kind of account. Think of it as a basket that holds your investments, your stocks, your funds. And the government gives this basket some pretty powerful tax advantages to encourage all of us to save for the long haul.
So here's our game plan. We'll start with the core concepts. Then we'll put the two main types of IRAs head-to-head. After that, we'll talk about how to choose the right one for you, walk through the expert-recommended savings order, and then wrap up with all the key numbers and rules for 2025.
All right, let's dive into the foundation. When people talk about IRAs, they're usually talking about one of two main types, and each one has a totally different flavor of tax benefit. We're talking about the traditional IRA and the Roth IRA. And here is the absolute most important thing to get your head around. Both of these accounts give you a fantastic tax break. The big difference, the question it all boils down to, is when you get that tax break. Is it now when you put the money in, or is it later, when you're retired and taking the money out? Okay, so let's put them side by side. I find that when you see the differences laid out like this, the choice becomes a whole lot clearer. So here it is, the fundamental trade-off. With a traditional IRA, you're using pre-tax money. That means you could get a tax deduction this year, which is awesome. The catch? You'll pay income taxes when you pull that money out in retirement. The Roth IRA, it's the complete opposite. You put in after-tax money, so there's no deduction today, but, and this is a big but, your growth and your qualified withdrawals in retirement are 100% tax-free.
So, with that all laid out, how in the world do you choose? Which one is the right strategy for your life and for your future?
Honestly, it really just boils down to this one simple strategic question. You have to ask yourself, do I want my tax break now, or do I want my tax break later? And the answer to that really depends on one big guess. Do you think you'll be in a higher or lower tax bracket in retirement than you are right now?
And this right here perfectly illustrates that strategic choice. So if you're in your peak earning years right now and think, hey, my income will probably be lower in retirement, then that traditional IRA with its upfront tax deduction looks pretty sweet. But if you're just starting your career and expect your income and your tax bracket to go up over time, man, locking in that tax-free growth and those tax-free withdrawals with a Roth IRA is an incredibly powerful move for your future self.
And the Roth IRA has a few other awesome tricks up its sleeve. For one, you can actually pull out your original contributions, not the earnings, but what you put in, at any time tax-free and penalty-free. Plus, unlike a traditional IRA, there are no required minimum distributions, or RMDs. That means the government never forces you to take money out, which gives you a ton more control and flexibility. Okay, time for the action plan. Financial experts pretty much all agree on a clear order of operations to make sure you're getting the absolute most out of every single dollar you save for retirement.
Think of this as your financial ladder. Step 1 is a complete no-brainer. You always want to contribute enough to your company's 401k to get the full employer match. I mean, it's literally free money. Don't leave it on the table. After you've gotten that match, then you move to step 2 and you max out your IRA. Still have money left over to save? Great. Go back to your 401k and contribute more. It's only after you've maxed out all those tax-advantaged options that you should move on to a regular old taxable brokerage account.
And this is a super important point that a lot of people miss. Just opening an IRA and moving cash into it isn't the end of the story. If you do that, the money is just sitting there, not doing anything. You have to actually invest that money inside the account, into things like ETFs or mutual funds, to actually put it to work and let it grow for your future.
Okay, let's wrap this up with the nitty-gritty. Here are the specific numbers and rules you're going to need to know for 2025 to put your plan into action. All right, for 2025, if you're under the age of 50, the magic number is $7,000. That's the most you can put into your IRAs, whether it's all in a Roth, all in a traditional, or some combination of the two, for the entire year. Now, if you're age 50 or older, you get a nice little bonus. The government allows you to make what's called a catch-up contribution. That's an extra $1,000, bringing your total annual limit up to a cool $8,000.
Now, you do have to be aware of some income limits, okay? And these are based on your Modified Adjusted Gross Income, or MAGI. For a Roth IRA, if you're married filing jointly in 2025, your ability to contribute directly starts to phase out once your income hits $236,000. For a traditional IRA, the ability to deduct your contributions starts to phase out at $126,000, but that's only if you also have a retirement plan at work.
So, what if your income is above that Roth IRA limit? Does that just lock you out of all those amazing tax-free benefits? Well, not necessarily. There's actually a pretty well-known, totally legal strategy to get around it.
Yep, it's called the Backdoor Roth IRA. And the process is actually pretty straightforward. You just make a non-deductible contribution to a traditional IRA, because there's no income limit to do that, and then you simply convert that money over into a Roth IRA. It's a fantastic way for high-income earners to get access to all that powerful, tax-free growth.
You know, the big takeaway here is that you've got options. You're in control. By understanding this whole tax break now versus tax break later thing, by following a smart savings order, and by knowing the rules, you can make the strategic choices that put you firmly in the driver's seat of your own financial future.
So, we've laid out the entire map for 2025, from the big picture strategy all the way down to the nitty-gritty numbers. The only real question left is, what's the first step you're going to take? Thanks so much for joining us on The Explainer.